Bonds. A bond is a loan that you, the lender, gives to a larger organization, the issuer, such as the government, or a top-earning company. Let's say your friend Gidget represents the U.S. government. You give Gidget $2,000 to fix your car, and she promises to pay you back at 3% interest or 3% coupon rate in 5 years. This $2,000 amount is what is known as the face value or the par value in the bond market. The due date of 5 years is the maturity, but in the meantime, she will pay you $60 in interest every 5 years. But when the 5 years are up, she will return the full amount of $2,000 plus the $60 of interest. This is basically how a bond works. There are different kinds of bond investments depending on who the issuer is. The first ones are government bonds, which are generally considered safe investments. There's a subset of government bonds that protects the lender from inflation called Treasury Inflation Protection Securities, or TIPS. Municipal bonds, or munis, are issued at the state and city level. These types of bonds are exempt from federal taxes, even state taxes, depending on where you live. Corporate bonds, on the other hand, are issued by top profit companies such as Apple, Microsoft, or Facebook. How do you tell which bonds are safe investments? Each organization has a bond rating based on 3 different scales. There is Moody's, Standard & Poor's, and Fitch. The companies with ratings in the range of BBBs or Baa or above are considered very safe investments and are less likely to default. These are called investment-grade bonds. The AAA ratings would include bonds such as the aforementioned TIPS, since they are government issues. Ratings in the BBs or Ba down to the Cs and Ds are bonds with moderate to high risk of default, but they have the highest yields. These are called junk bonds in the bond market. The companies with the single-letter ratings are considered by some experts to be on the brink of default. No one knows what the future economy entails, so always remember to do more research on an organization or corporation before investing in them. If you guys haven't watched our previous video, we highly recommend you watch that one first. We talked about the stock market indices and what their points mean. Now, introducing the bond market indices. Just like the stock indices, bond market indices are calculated mostly using market cap weighted averages. There are sector-based bond indices and broad-based market indices, meaning it tracks all sectors of the bond market. The S&P 500, the Dow, and the Nasdaq all have separate indices designated to track the bond market as well. The Bloomberg Aggregate Bond Index, or simply the AGG, is one of the most well-known bond market indexes. The AGG is a broad-based index and is made up of more than 10,000 some investment-grade level bonds in the US. Although we've only talked about the most well-known indices out there for both the stock and bond markets, there are countless more out there. Take, for example, the Bloomberg Barclays Multiverse Index that is a union of many different bond market indices from around the globe. Now you're wondering, what is the difference between a share and a bond? When you invest in stocks, you own a piece of that company. When you invest in bonds, you are basically lending money to an organization with the promise that it will pay interest every year, and at maturity they will pay back the full amount. Using Gidget again as an example, the difference between stocks and bonds is you giving Gidget $2,000 so you too can claim ownership of her car, versus giving her the money and having her pay you back without you claiming ownership of her car and therefore having no say as to who gets to drive it. Because you own a piece of a company with stocks, whatever profit they make, the company will disperse to its shareholders in the form of dividend payments. In other words, as a shareholder, you only receive payment only if the company is doing well financially. If a company goes bankrupt, they are required to pay back the bondholders first. They may or may not get to the shareholders. This is why stocks are high-risk investments. And lastly, both types of investments are traded on an exchange. So now that we've had an overview of stocks and bonds, let's change gears a little bit and look at a different way to invest. Mutual funds and its 2 subcategories: exchange-traded funds, or ETFs, and index funds. Imagine you and a bunch of your friends putting together some money to pay for a cruise trip. This is how a mutual fund operates. It is basically a bunch of investors like yourself and I pooling money together in order to afford a bundle of investments. With a mutual fund, there are investment advisors whose main job is to research and pick these different assets to add in the bundle. This happens on a consistent basis. So rather than investing in one top company from one sector, you can bundle together the top 1,000 or so companies in that particular sector to invest in with one purchase. Or you could purchase a bundle of the top performing company stocks and bonds from all the different sectors. And just like on a cruise where you pay the crew for their knowledge and expertise, you pay the investment advisors or fund managers for theirs. Think of the cruise ship as the mutual fund itself, where every scene of your vacation represents different kinds of investments, all rolled into one sailing adventure. The result is a diversified investment portfolio. Keep in mind that since you are paying experts to do the research and managing for you, it is more expensive than ETFs and index funds as we move forward. Oftentimes, seeking out expert advice may or may not work in your favor. Even experts can't predict a future, and you could just end up losing all of your money while they keep theirs. Take, for example, the recent COVID-19 outbreak, which devastated so many businesses around the world. Moving on to index funds. If mutual funds were actively managed by professional investment advisors, then an index fund is something that is passively managed. This is because the assets are already pre-selected by picking investments that are already listed on, you guessed it, on an index. This way, you don't have to spend money on professionals to do it for you. So by investing in a group of well-performing companies with one purchase, you save money and time. One of the good things about index funds is that you get the option of automatically reinvesting your accumulated money with a click of a button at no additional charge. Index funds are often the cheapest choice out of all three and outperforms most actively managed mutual funds over time. Next up are ETFs. ETFs are very similar to index funds in that they are a bundle of investments and often bundle companies that are listed in indexes such as the S&P 500, the Dow, and the Nasdaq. There are some key differences to note between ETFs and index funds. Index funds and mutual funds are purchased through a fund company or firm at the end of the day when the market closes at 4 p.m. With ETFs, you can buy and sell throughout the day on an exchange when the market is open. This means the price is guaranteed to fluctuate. So if you are in the US, the trading hours starts at 9:30 a.m. to 4 p.m. Eastern Time, Monday through Friday. And unlike index funds where you can choose to automatically reinvest, with ETFs, you'll just have to keep buying more at your own discretion. So by now you may be wondering, how much of stocks and bonds should I invest in to diversify my portfolio? According to the Social Security Administration website, one can expect to receive their full retirement package at the ripe age of 67 if you were born in and after 1960. With that in mind, let's look at a quote from the book All About Bonds, Bond Mutual Funds, and Bond ETFs by Esme Ferber. The author states, "It is your time horizon until you begin to draw from your investments that determines your asset allocation." Meaning, the younger you are, the more risk you can take on since you have a long time until retirement to make up any money you could potentially lose in the stock market. So the younger you are, the more you should focus on growing your money by investing in stocks. The older you get, the more money you should set aside in bonds. You could fight risk via stock mutual funds, stock index funds, and stock ETFs. This way, if one stock out of 8,000 goes down, you have thousands more to make up for it. Same thing goes for bond mutual funds, bond index funds, and bond ETFs. This is a chart we took straight from the book showing how the closer you are to retirement, the more money you should be investing in the bond market instead. Money market securities yield more money due to interest compared to your regular checkings and savings accounts. An example of a money market security would be a certificate of deposit or a CD. Where do you go to buy these investments? We already gave you a few ideas in the last video, but the list today consists of firms that have stood the test of time: Fidelity, Schwab's, Vanguard, Interactive Brokers, and Saxo Banks. While Interactive Brokers and Saxo Banks can be accessed internationally, the rest can only be accessed in the US. Side note, if you are a beginner, the Vanguard website is really confusing and not that easy to navigate. So let us know in the comments below where you are on the investment journey and what topics you would like us to explore. Until next time,